Welcome back. You're watching The Money Show on ET Now. Let's welcome now on the show Mr. Lovaii Navlakhi. He's the MD and CEO of International Money Matters. Mr. Navlakhi, thanks so much for joining us today on The Money Show. You know, just in my introduction, I was talking about how there are more than 40 mutual fund houses and more than a dozen mutual fund categories. So basically, today the investor is spoiled for choice. There's just too much available out there. So if I have to curate, a portfolio of mutual funds, what are the parameters and factors that I should look at?
Yeah, thank you, Mubina, for having me. I think it's important that when someone is investing in mutual funds, I'm guessing that they're looking for consistency over a long period of time. And they're wanting to make sure that in different market conditions, their fund sort of performs. Because you don't really want to be getting in and out of mutual funds because you'll unnecessarily pay an exit load, you might pay short-term capital gains, etc. So essentially, I think that it's important to look at rolling period returns. That is not returns from point to point, because those could at times be misleading, and I have some data on that which I thought I'll share with you a little later. So it's important to look at rolling returns. The other important factors that you need to take into account is, what is really been the track record in different market cycles for that fund. What is the size of the fund? And typically you find that in equity funds, a smaller size or a little more optimal sort of size is beneficial. Whereas a very large fund may not be able to make very swift moves in and out of different segments or sectors. So while in an equity fund, the slightly smaller size is preferred, in a debt mutual fund, the larger the fund, the better it is, because they possibly are in a position to negotiate better, get better sort of deals, better prices, as well as have a sort of stronger team which will evaluate those investments. I think also at the end of the day, you want the fund manager to be in a position to enter and exit certain holdings. More importantly, exit certain holdings when he decides that he wants to. And therefore, liquidity in the portfolio is also important. What it means is that if I have a certain allocation to, let's say, small cap stocks, but that individual stock, my holding is, although it's small, it is over 3 days or 4 days only, I can sell my entire portfolio. I might get stuck with that holding. What we also pay attention to is the type of team that the fund management has, the fund house has, how stable it is, what has been the past experience when maybe a star fund manager has left, how have they managed. So I think those are important factors. However, I suppose the common way most people tend to think of is, what's been the returns. And right now, I think a lot of people are thinking that they have missed out a huge rally, because everyone seems to be talking about the type of returns that the market has given. So I have some data that, and I'm not gone into a mutual fund, I've just gone into a category because people think that equity is a very risky category. But when I look at the last 1 year return in mutual funds, I find that the large cap index, the Nifty, has grown by 47% in the last 1 year. So that makes me very tempted to say, great, this is what can happen also in future. So let me invest in mutual funds in equities. Then I speak to someone else and find out that, oh no, don't go into the large cap category, because the large cap category has only given you 47%. If you were in the mid cap index, you would have got 78%. And then someone tells you, no, small cap index has given you 106%. And this is actual data as of today. That's the 1 year return. Now, if you're going based on the last 1 year return, I only sort of would ask you to rewind back to 1 year ago, because that's when you would have made this decision to go into small cap. And at that point in time, the previous 2 years returns of small cap was minus 33%. the large cap index was flat. It was 0.3% in the previous 2 years. So if you are ever going to go by past returns, you're not necessary that you're going to get those type of returns in future. So it's very important that you look at, risk adjusted return, the size, and all these various factors that I spoke of. At the end of the day, it does seem like it's possibly better to deal with somebody who is doing this sort of research, unless you are very equipped, have the time, have the inclination, and the competency to evaluate all these factors before choosing a fund house.
I think a lot of things actually struck out as being important from what you said. Firstly, you spoke a lot about the past performance of the fund. And secondly, you spoke about what the fund size is. So I think the past performance bit is more important, because usually retail investors tend to just look at the past performance and say, okay, they've done well, so they'll continue doing well. Do you see history repeating itself? There's a thing that history does not necessarily repeat, but it rhymes. So, how do you overcome that bias?
See, I think the unfortunate thing is that literacy about how to select a mutual fund or how you should plan your investments is limited, despite all the efforts that, channels like yours, a lot of other media, a lot of advisors and planners have been making over the last few years. It's still sort of limited, and we always find that the first time investor typically looks at, what was the return last year? Because last year I got 5% in my fixed deposit. Oh, this gave me 45%, let me put money here. And they start sort of evaluating things based on that last 1 year return. And it is very important to go back in history and look at whether past 1 year returns have resulted in similar future, because you're not investing in the past, right? You're putting in money now, and you're wanting your investment to give you the type of return that you're hoping to. So I think there are many factors. So this is all fund house specific. I've not spoken about the fact that there will be specific situations that the individual has. There is certain things that we need to take into account vis-a-vis the market, valuation, volatility, sentiment, liquidity, whole bunch of things. It does get fairly complex, and for some time it might feel like, oh, I based it on previous returns and see what's happened to me in the last, say, 3 months. I've made 20% return or 30% return if I was in mid cap or in small cap category. But I think you have to be really careful about this and make sure that you understand the risks as well of such investing.
Okay, understood. Now, Mr. Navlakhi, let's talk about the size of the fund. You spoke a little briefly about how the size of the fund matters. So, is it that you would recommend retail investors look at only a certain amount of AUM, and if the fund is above AUM, essentially, for our viewers, it's assets under management, which indicates the size of the fund. So should investors only invest in funds that have a certain amount of AUM and above that?
So yes and no. I think you mentioned that there are so many different categories of funds. So each category of fund sort of calls out for a different type of approach. So if I'm parking money, let's say large sums of money in a liquid fund, where liquidity for me is very, very important, then obviously the larger the fund, and there the return is not so important. The larger the fund, the better sort of would be that particular fund's portfolio, because it's likely that in a smaller fund, there may be a high sort of weightage on a particular investment, and therefore there could be some risk. Then I get into debt funds. Now in the debt fund category, typically it does seem like the larger the fund, the better sort of risk mitigation measures that the fund would possibly be able to take. One. Second, we all know the experience that investors have had with certain companies and certain debts which have defaulted. So let's say take the classic case of Ireland FS, which happened a few years ago. Now, if I had bought an ILFS bond, then my entire money is stuck. But if I had gone into a mutual fund, it is possible that that fund had a 2%, 3%, 4% allocation to ILFS. So only that small portion of my investment would have, caused a problem. Now, typically, as the fund sizes get larger, the allocation in this and the distribution of the investment is slightly better. So yes, you have to also look at the concentration risk in a debt fund. But keeping in mind that, as you get larger, you'll sort of distribute better, then the larger fund is better. In the equity fund space, now, if I go into, let's say, an index fund, or I go into the large cap category, and I'm pretty much having to invest in the index, then that fund is fine whether it is large or small, because it has the same number of stocks that it's going to invest in. It typically is into the most, the highest value market cap funds, market cap stocks, which means that there will be a high amount of liquidity in those. So that's not a problem. But as soon as I get into mid cap, small cap space, or even a flexi cap type of fund, which is given the ability to determine how much to put in large cap, how much in mid cap, how much in small cap. Now here what happens is, if I'm in a very large fund, I may not be able to allocate too much money into the smaller cap stocks, and I may be find myself less flexible in terms of moving in and out of a particular category. Whereas a little smaller fund may be able to do much better in that situation. So I'm sorry, there's no single answer to say large is better, small is better, medium is better. It's different categories of funds require a different sort of approach in terms of choosing the size of the fund.
Yeah, of course. I mean, this is a very subjective question. The entire topic as well is very subjective. So understandably, there's no single answer. There's no single figure that, okay, the AUM has to be above 10,000 crores or something, which would obviously make every retail investor's life very, very simple. But yeah, it's subjective. It differs quite a bit, even across mutual fund categories. All right, Mr. Navlakhi, let's talk about then judging a mutual fund performance. Again, in your first answer, which was all encompassing, you spoke about looking at the returns across different market cycles. So is it important that we look at the return not just very absolutely, but compare it with its peers, with the benchmark, and how do you determine the different time periods that you should look at the returns?
Yeah, so I think it's the first answer to the time period to choose to compare the return is probably the time period over which you are intending to invest. And I'm hoping, as some of the experts said before this interview started, that you're looking at 5 years, 7 years, up to 25 years, as one of them said, for investing in the equity fund. So it's important to look at that. We talk about a concept of rolling return. That is, what is the return, if I'm taking 1 year returns and I'm comparing it over the last, say, 5 years, then I'm looking at, what was the return from 7th July 2016 to 2017, then 8th July 2016 to 8th July 2017, and so on and so forth. So I'll have a series of 1 year return scores, and then I could take an average of that and find out, what really has been returns if I take a day-to-day movement. But to make it simple, I think quite a few websites as well, when you look at performance, have data on what is the best returns that this fund has given in a quarter, in a month, in a year's period, over the last 3 years, 5 years, 7 years, and what is the worst return. So even that sort of allows you to look at what is the amount of the concept. There's a concept known as drawdown. So what is the maximum amount I could lose even temporarily in the fund? And that is also, based on the comfort level that I have as an individual investor. How much risk am I willing to bear? How much shock is okay for me and what's too much for me? I think those factors come into play. I think the part of, at different cycles, there isn't too much public data on, okay, the cycle of bull run started on XY date in end of 2008 and ended on this date in 2011. You don't have data like that. But if you actually went and looked at the market movements of the past, and you could pinpoint on the graph that this was a top, this was a bottom, then you can try and see if you can find data of how this fund performed in that period. So that's absolute return. Then, like you said, it's to compare how peers did. So if I'm investing in a large cap fund, how did other funds do and what's the rank of this fund? Again, that data is available. The third thing is how is this done versus its benchmark? And I think you just need to be a little kinder when you go through very sharp movement. So like the February, March of 2020, where we had a very sharp movement, if that period is incorporated in your return period, then when I'm comparing, versus benchmark, I have to be a little kinder because the fund manager may not have acted, immediately, and you might find, oh, there is a big divergence. But if you then added rolling return, etc., you would probably smoothen out the return and make a better sort of decision. The whole idea is that we don't want to get in and get out of funds. If you wanted to do that like a day trader in stocks, okay, I'm buying today, selling next week, etc., your approach might be different, but I think then your losses will also be pretty high because you'll pay exit loads and short-term capital gains tax every time you get in and out.
Okay, understood. Well, let's do one thing. Let's move on and take on board some questions and queries then that we've received from our viewers. And our very first question is coming in from Sahil Rao. Now, Mr. Navlakhi, this is actually just a question we've received. Sahil Rao has his question on three funds. The Quant Tax Fund, which is essentially an ELSS scheme, the Canara Robeco Blue Chip Fund, and the PGIM Flexi Cap Fund. Now, he is asking your view, Mr. Navlakhi, on these three funds. He's saying he wants to invest 10,000 rupees monthly in these three funds for the next 5 years. So I think he's very specific that he has a 5-year time horizon. He's not mentioned what exactly is his goal is, but do you think that perhaps he should add more funds to his portfolio? What do you think of these three funds?
Yeah, so I think before getting into specifics, I think if I'm going to invest in equity funds, and 5 years is a good time horizon, SIP is a good way of investing, I would first start with an index fund. Assuming I'm a first-time investor, then I would go for an index fund because I want a large cap exposure instead of taking an actively managed large cap fund like a Canara Robeco Blue Chip. And I'm not making a comment on Canara Robeco Blue Chip. It's not a bad fund, but I would first put money in a index fund. The question that I have is on the ELSS fund. ELSS typically, as one knows, you get a tax break if you invest up to 1.5 lakh per year under Section 80C. So if he needs a tax break, then I would do 12,500 rupees a month, which covers the 1.5 lakh. And in case he's starting now, that is in the month of July, and he has only 9 months to go, then obviously is to increase that amount to match that 1.5 lakhs. In the type of funds that we would recommend, we don't particularly recommend quant. Again, there we look at size. This size possibly is slightly smaller. So we would do another tax fund if they do need a tax fund. The choice of having a flexi cap fund as the third fund, once I have a large cap fund as the second fund, is a good choice, and PGIM is a good scheme by itself. In terms of number of schemes, I think if I'm a first-time investor, then 3 schemes are fine. If I'm a more experienced investor, I might pick only 2, and it depends on whether I needed that ELSS or not. If I didn't need ELSS, then might be I would go for a mid-cap fund because I have a 5-year horizon. If I had slightly longer, I might have taken a small-cap equity fund.
Okay, so that's the recommendation. A few chops and changes, a few additions recommended by Mr. Navlakhi. Well, our next question is coming from Rajesh Daswani. He says, I have about 15 lakh rupees invested over the last few years to purchase a house which comes up in 2022. That's next year. Now, in light of the current situation, I have stopped my SIPs in some funds. Now, his aim obviously is to preserve capital because, you know, he has to buy his house in the next year. So his duration now has shortened to 6 to 9 months. Please advise how I can trim my portfolio and keep risk minimum. So he's got the ABSL Money Manager, Tata Banking and PSU, Mirae Asset Large Cap, L&T Mid Cap, IDFC Ultra Short Term, ICICI Pru Ultra Short Term. All right, so lots of debt funds, in fact, just 1 or 2 equity funds that he's got his SIPs in. And he still has a few SIPs continuing as well. IDFC Ultra, HDFC, ICICI Ultra Short-Term Duration Fund, SIPs are continuing. In total, he's got 15 lakh rupees. You know, his question is very valid. He has put a hold on the SIPs. He hasn't redeemed any equity mutual funds yet, but he's put a hold. How should one start managing their investment portfolio when their goal approaches? Just like Mr. Rajesh's case, it's coming up in the next 6-9 months. So what should he do now?
So I think that when someone has their goals coming up in the next 6 to 9 months, I would have possibly looked at little earlier, maybe 12 months earlier, to start reducing risk. But in his case, I mean, he's been fortunate. The last 3 months have been pretty good on the equity market front. Now, if he has done it over the last few years and he therefore all his equity investments are long-term in nature, then our recommendation would be to gradually, not slowly, but gradually quickly, get out of the equity funds and park them into safer instruments, which could be liquid funds or short-term funds like he has done. The better option, if I have a 6 to 9 month horizon, are arbitrage funds because they have tax applicability based on equity, and to that extent it is a possibility that the post-tax return will be slightly better than the ultra short type of funds. Among the funds that he has mentioned, I think there are a couple of funds, ICICI and Nippon Ultra Short Funds, which have slightly riskier sort of portfolios. So maybe we should sort of reduce that rate, because I think he has too many short-term funds. I mean, he's distributed them because I'm guessing he's sort of worried about debt funds, you know, based on some sort of past issues that were there in debt funds in the market from time to time. So I would sort of reduce those two schemes. And otherwise try and you know, get into arbitrage funds. That might be better option for it.
All right, there you have it. You know, that's the word coming in. Let's take on board our next question. It's a very relevant one. Santu Mundal asks, what's the impact of inflation on someone who's young, investing for retirement, and a retired senior citizen who can't cope with inflation? Both cohorts, of course, look at inflation very differently, can handle inflation as well very differently. But what's your view, Mr. Navlakhi, of the impact on inflation? Do you think it's a bit more severe on the senior citizen who, you know, in all probability does not have income, A, and B, has mostly parked their money in fixed income assets?
Yeah, I think, you know, when people get into retirement is when they feel the most nervous, and maybe the first few years of that period when they are moving away from a time when they were earning to now suddenly they have stopped earning. So the question always is, do I have enough? I'm never going to be able to, you know, top up my money back up in the investment in my corpus. So is this something that will last forever? Now, typically, we must recognize that the Reserve Bank of India, in India's case, and the central banks everywhere will try and make sure that real interest rates are positive over long periods of time. In short periods, yes, it's likely that the interest you're getting is lower than the inflation rate. But over time, my guess is that that's something that would get sort of rectified. So one doesn't need to equate it and say this is what's happened in these 3 months, 6 months, 1 year. This will always happen through my retirement period. That's one point. For the youngster, I think it's important that they recognize that whenever they are investing, they have to keep investing for the rainy day. When you get to retirement and you have a situation where inflation is higher than your interest rates on safer assets, you should be able to pull out from that rainy day fund and use it. And I think that even for those who are in retirement, it's important that they are planning for a long period of time because life expectancy is high. And you need to plan for that in any case. So some portion of the asset should be in, inflation beating investments, which possibly is equity funds. Because some of that money that you have today, you're going to draw upon only 5 years, 7 years later. You're not going to withdraw all that money that you have in the next 5, 7 years. So a little bit invested for a little longer period of time is much better. We have a simple bucketing strategy saying anything that's coming up in the next 12 to 18 months, very, very liquid. Anything that's coming up between that 12-month to 3-year period, I want to be extremely safe. But anything beyond that, I can, based on my risk profile, have some portion of that investment in growth assets. And this is something that you reset all the time. As you finish the first 12 months, the next 12 months requirements will come up in that first bucket category, and therefore you keep moving part of your assets, and that probably gives you a little peace of mind, is what we found.
All right. So that's of course about inflation, and I think it's a very relevant question as well, because right now all of us are looking at inflation with dreaded eyes. The last reading was 6%. I don't know what the next month will hold for us. We should have the next inflation reading next week. So I guess we'll wait out for that. Okay, Subba Reddy writes into us saying that I invested 20 lakh rupees in the Axis Banking and PSU fund for retirement, which is going to happen in 5 years. Now he's saying that the debt fund return is low. He's asking you, is it advisable to activate an SWP to equity MS for 3 years in SIP? Okay, so I think what he's trying to say is that he'll slowly start transferring money from the debt fund, from the banking and PSU fund to an equity fund for 3 years. Is that advisable, especially when his retirement is up in 5 years?
Yeah, so I think he's obviously worried that he's not getting the type of return he thought he might get. The yield to maturity of this fund is 4.4% per annum. It's really investing in short-term paper. So if he was planning for retirement in 5 years, this is not the fund. So I think this is one of the things we've been saying, that you match the type of fund with your time horizon for investing based on the type of paper or type of investment that fund is making. This fund is only investing in papers which are maturing in 1.5 years. So you're obviously going to find this sort of dichotomy between the return of your expectation and the fund that you have chosen. I think if you're worried about this and you still have 5 years to go, then I think and you're fine with some amount of risk, one of the options with part of the money would be to get into a balanced advantage type of fund, what used to be called dynamic asset allocation type of funds, which will automatically move the equity allocation. As the markets get expensive, they reduce the equity allocation. When markets get cheap, they increase it. So that fund will typically get taxed like a equity fund. So maybe for the next year and a half, part of this money, again, I'm repeating part and not all of this money, can go into a fund like this, where hopefully you're getting some sort of like low double digit type of return. That's an option I would sort of consider for part of the money. For the other part of the money, since he still has a longer term horizon and he can hold for 3 years odd, then looking at a little more longer term type of fund, maybe government security type of fund, so there's no default risk at all, is another option. But he has to remember that he has to hold for 3 years, only then it becomes long term, and therefore taxation he needs to be worried about or taking care of. So.
Okay, well, that's of course the news coming, the view coming in, pardon me, on what should be Subba Reddy's strategy. He's invested in the debt fund for his retirement, which is, by the way, in 5 years, and 5 years you could call it a medium time duration. All right, Mr. Navlakhi, with that, we are going to wrap it up. Thank you so much for joining us in today's episode of The Money Show and enlightening our viewers with the basics of, picking a mutual fund and the factors that one must watch out for. Thanks once again.
Thank you.
And I think with that, we are going to take a very short break on the show, but we'll be back with some interesting news and the top stories of this evening on ET Now.